Stanley Druckenmiller is one of the greatest investors of all time, arguably potentially even greater than the Oracle of Omaha himself, Warren Buffett, where Stanley Druckenmiller's track record includes 30% plus annualized over 30 years. To put that math to paper, that's over, if you were to take $1, that would be $2,600 plus over those 30 years. Keep in mind, that's also without one single down year, and in 2008, he was also up, I believe, double digits. So arguably one of the world's greatest investors. The question is, how did he do it, and what is his current outlook on the market? I'll talk about both in just one second. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, no hype, mission focused channel, trying to find you exceptional companies and unrivaled investments, types of stocks that could potentially go up hundreds and thousands of percent over time. That's the goal, hundreds or thousands of percent over time. And so if you enjoy learning about those types of companies, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey each month, calling out potential multi-baggers, these types of companies that I think have, asymmetric risk reward, go to unrivaledinvesting.com, click on journey. Each month, first week of the month, I also call out my full portfolio with all the reasons why. Let's get back to Stanley Druckenmiller. How has he done this incredible investment track record, and how has he done it? And what does he think of the current investment landscape? So understanding Stanley Druckenmiller, as we learn about him, is that it's not about batting average. When you think about baseball, it's about slugging percentages, which is how often do you make this big bet where you make a ton of money. So it's about managing your risk reward with your portfolio and concentrating your bets. So that means betting big when you like your risk reward, when you think the asymmetric, where you think that the odds of blow up is insignificant and that you have a very good asymmetric risk reward. And so that is a key point to think about: slugging percentages versus batting averages and concentrated positioning. And he also, likes to say, look, a lot of modern investment theory is, you got to spread your eggs across multiple baskets. No. He's like, put all your eggs in one basket. Actually lowers your risk as you're now concentrating on what is in your basket. You're laser focused on what are the potential things that can blow up your portfolio when you concentrate it. And so I think it's a really interesting thought process, and arguably he's right, because you look at several of the other greatest investors out there, very different investment styles, investing in different things, but a commonality of investing concentrated bets. Carl Icahn, Warren Buffett, Stanley Druckenmiller, making these concentrated bets on the things that they think have asymmetric risk reward and very low blow-up risk. And he's also playing a very different game. He's playing a global macro liquidity game, looking at how cash is sloshing across the world, trying to figure out where is it going to end up? Where can the cash end up, and how is it going to move security prices? As an example of how he thinks the world is looking today is that the U.S. is running crazy deficits, and the Federal Reserve has effectively radical, incredibly risky policies that is ultimately going to drive the U.S. dollar lower. And as investors realize they can get potentially better returns elsewhere, the U.S. dollar not only will decline, but so will other U.S. related assets. And that's actually a bet that you've seen from another of the super investors. You're looking at Michael Burry, and I called out his portfolio recently where he's making a bet also arguably against U.S. dollar by shorting TLT, or those long-dated treasury bonds. So you do see some sort of commonality here. And so he's tracking liquidity, thinking about how cash could be moving in and out. What's the Federal Reserve doing? Is it tightening? Is it loosening? What's it going to do if it has to respond to inflation? These are all the different considerations he's doing as he's thinking about the investment landscape. Also, it's worth understanding he has a multidisciplinary approach where he's looking not only about the liquidity and how cash is moving around the world, but he's also looking at the fundamentals of individual investments, building up a bottoms up analysis, saying like, hey, this is clearly a compelling investment, but then understanding, okay, you're going to be riding sort of this macro benefit of, let's say, lower interest rates, and that's going to drive the valuations to expand. And then he also considers a technical analysis as well, looking at price action, and that is a key element that a lot of investors miss, where as price action, let's say, starts giving you a red flag, some investors just keep averaging down, average down, without actually saying, well, wait a second, what's going on? And this is how a lot of investors blow up, versus Stanley Druckenmiller, where his approach is, hey, if I'm wrong, I get out. And he's constantly, so he does have higher turnover arguably than most investors, than several of the other great investors, but it is sort of approach of saying, hey, he's doing what fits for his own personal journey, and he's looking to say, hey, I only want to be in setups where the fundamentals make sense, the liquidity makes sense, he understands that framework, and he also likes the technicals. He likes a chart saying, hey, this is a favorable, price action that I'm looking at. So this is really interesting perspective, and it certainly reflects a willingness to change his opinion often. So, if the price action, let's say, starts going against him, or there's something changes about the macro, the Federal Reserve starts changing their policy, that will change his opinion. And case in point, March 2020, he blew out of stocks as he saw the price action start turning unfavorably. But by April 2020, based on effectively the Federal Reserve going all in, he was like, okay, let's buy it back. Now he didn't go, let's say balls to the wall on this and just go crazy, aggressive. But it's amazing to hear the open-mindedness he had to go completely out, completely cash, and then go back in just in April. And that reflects a certain open-mindedness that arguably most investors don't have. And honestly, even if they did, they'd probably screw it up. And so it is worth considering that willingness to change your mind. And that's just so incredible. And ultimately, he has a deep passion for capital markets, analyzing investments. And I can certainly empathize with that, where he liked to say, like, look, if I effectively didn't make billions of dollars, I would have been doing this for free. And that's an awesome thing to say. I can empathize with that, like that deep passion, because like, hey, if I didn't have you, the loyal YouTube community, I'd probably just be talking to the walls and the animals around here. And Lord knows I talk about stocks at family dinners, and family's just like, oh God, Daniel, please skip Daniel's turn. Let's move on to the next person. So I'm grateful for you, the YouTube community, where I can share my musings on the investments, the investment horizon, and the super investors. And so what are sort of the key themes that he's considering right now? So first of all, he thinks the Federal Reserve, as I already alluded to, is incredibly reckless with their policies. Case in point, with their buying tens of billions of housing-backed bonds each month, we're already looking at housing scarcity, home prices galloping higher. It does not make any sense for the Federal Reserve to be buying tens of billions of mortgage-based bonds currently. And also, the Federal Reserve should be forward-looking. A lot of the indicators they're looking at are lagging. This doesn't make any sense for them to be looking at employment right now, when or to be having this hyper-aggressive action of buying 120 billion plus in securities per month right now, when you need to be forward-looking about where could the market be in the future. And that's another key attribute of how he thinks about investing, is it's not what's going on right now, it's what does the world look like in 18 months from now, constantly looking at that time frame. And he thinks this incredibly reckless Federal Reserve has resulted in several little bubbles popping up, case in point with Dogecoin or NFTs, and the speculative SPACs, where you have multi-billion-dollar valuation and immaterial revenue. And he thinks those are all just byproducts of just incredibly loose monetary policy. He's also incredibly cautious, very cautious, on U.S. stocks. In his own words, he expects to make an exit by the end of the year. Why would he expect to make an exit by the end of the year? Once again, it's thinking about where the Federal Reserve is going to be by the end of the year. He's thinking, hey, look, the Federal Reserve is ultimately going to start to have to tighten. And once they do, those growth stocks, they're going to take a hit. Those long-durated, those stocks that are effectively valued as long-duration assets, they're going to take a hit. And so he thinks, look, once the Federal Reserve has to respond to that inflation, boom, these stocks, U.S. stocks, are going to take a hit. And look, you look at, Dr. Michael Burry called out in his investment portfolio, he's arguably making a very similar bet. He's buying puts on growth-related, ETFs, and he's making a big, he has a big bet against Tesla. He's got a big bet against U.S. Treasury, saying, hey, interest rates are going to go higher. So these are all, they're very similar to Stanley Druckenmiller, effectively betting against the U.S. dollar and what's that looking like. And he also talks about how the U.S. bull run, in his words, it's going to end badly. I just don't know when. And I think that is very fitting to sort of understand, look, this is what it's managing and watching the liquidity of the Federal Reserve. Once the Federal Reserve changes, he's going to change his game as well. And right now it's still dancing because the music's playing, but you can see that rotation in some key indices like the growth ETFs. They're not making their new highs like they were previously. And he's also long the things that are working, the things that are breaking out with inflation, effectively the reflation trade, like commodities, like oil, and he's been short the US dollar. And so it's interesting to see these bets that he was a major growth investor for all these years, and now he's making these other bets based on what's working, saying, hey, I think it's going to be inflation. I think it's going to be owning these assets. He's also bullish on China, talking about how China represents about 25% of global GDP, but less than 2% of global investment portfolios. Contrast that to the United States, where the United States is about 25% of global GDP, but over 28% of global investment portfolios. So here's this huge mismatch between effectively GDP and investment portfolios. And I honestly, this approach makes a lot of sense to me. This discrepancy makes a lot of sense to me, because I look at a company like Alibaba. I made a video on it just a few weeks ago, where it's one of the largest e-commerce companies in China, and just based on its valuation, based on its margins, based on its cash flow profile, I'm looking at, dramatic, risk reward, asymmetry, where I'm like, wow, this actually looks pretty compelling. If this were a US stock, I think it would be multiples higher. In full disclosure, I do own Alibaba stock. And also, if you're interested in, once again, following my personal journey, I did call out in May a potential multi-bagger that I think trades below liquidation value, does trade below liquidation value, and I think has 2 to 3x upside over time. So that's for going to unrivaledinvesting.com, click on Journey. And so these are some of the key aspects of what Stanley Druckenmiller is doing right now and what he's thinking about. So one, it's what's his approach, which is find things that are working, having a multidisciplinary approach, concentrated betting. If things start going against you, price action starts going against you, it's not necessarily, averaging down, but sort of seeing, hey, what's going on with my thesis? What are the fundamentals doing as well? And also he's looking at where's the liquidity going? What's going on right now? He sees an incredibly reckless Federal Reserve policies in the US. He sees incredibly reckless deficit spending. And he compared it to sort of like the opposite of what you see with Paul Volcker and Ronald Reagan, in the early 1980s, which was the setup that drove a multi-decade bull run. He's like, the policies that we're enacting now are like the exact opposite of higher taxes, higher spending, more regulation, reckless Federal Reserve policies. This is the exact opposite that could potentially lead to decades of inadequate returns for investors. It's worth considering these concerns. And if this video highlighting Stanley Druckenmiller, his approach, and what he currently thinks of the markets has been helpful to you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.